Pleasant morning to you, Mrs. McDowell. I am Jerry B. Balawag, and I am going to discuss to you the major accounts. There are 5 types of major accounts: the assets, liabilities, equity, revenue or income, and expenses. An asset is anything that has current or future economic value to a business. Essentially, for businesses, assets include everything controlled and owned by the company that's currently valuable or could provide monetary benefit in the future. Examples include patents, is an exclusive right granted for an invention; machinery, any kind of equipment used in production or business operations. Examples of machinery are manufacturing equipment, office equipment, vehicles, computers, and machines used in service-related businesses. And investments, a payment made to acquire the securities of other entities with the objective of earning a return. Examples are bonds, common stock, and preferred stock. Liabilities is any debts your company has, whether it's bank loans, mortgages, unpaid bills, IOUs, or any other sum of money that you owe someone else. If you promise to pay someone a sum of money in the future and haven't paid them yet, that's a liability. Equity is also known as shareholders' fund, owners' funds, or net worth. Equity can be calculated by subtracting liabilities from assets and can be applied to a single asset, such as real estate property or to a business. For example, if someone owns a house worth $400,000 and owes $200,000 on the mortgages, that means the owner has 100,000 pesos in equity. Revenue or income is the total amount of income generated by the sale of goods or services related to the company's primary operations. In simple words, it is the income or profit of one's business. There are 5 types of revenue: service income, professional income, rental income, interest income, and miscellaneous income. Expense is the operational cost that is paid to earn business revenues. Expenses include wages, salaries, maintenance, rent, and depreciation. Expenses are deducted from revenue to arrive at profits. What are current and non-current assets? Current assets are those that you can convert into cash within 1 year, such as short-term investments and accounts receivable. Examples of current assets include cash, marketable securities, inventory, and accounts receivable. Non-current assets are longer-term assets with a full value that you cannot recognize until after 1 year, such as property and machinery. Examples of non-current assets include long-term investments, land, property, plant, and equipment, and trademarks. What are current and non-current liabilities? Current liabilities are the debts that a business expects to pay within 12 months. Examples are short-term debt, accounts payable or money owed to suppliers, wages owed, income and sales taxes owed, and pre-sold goods and services. Non-current liabilities are long-term obligations, including debts of the business, which are not due for payment within the next financial year. Examples are long-term loans and leases, lines of credit, and deferred tax liabilities. What are account titles? Account titles are the names given to the various categories used to keep track of a business's finances. For any and every transaction, these accounts are updated to reflect what happened in an organized and consistent manner. This is an example of account title. As you can see, it is clearly telling the classification of every transaction. What is a chart of accounts? A chart of accounts, or COA, is a list of all the accounts you must use to record financial transactions in your general ledger. It helps you keep track of where money comes from and goes. A chart of accounts is integral to your bookkeeping, accounting, and financial reporting. It categorizes transactions into primary accounts like assets, liabilities, equity, expenses, and revenue. Statements of financial position are commonly known as balance sheet. It serves as a snapshot, providing the most comprehensive picture of an organization's financial situation. It reports on an organization's assets, what is owned, and liabilities, what is owed. This is an example of balance sheet. It shows the assets, liabilities, and owner's equity of a business. A statement of comprehensive income is a broad financial metric that includes all incomes and expenses that affect a company's financial standing over a period. Shareholders and investors must use this financial statement to determine a comprehensive understanding of a company's financial health. The income statement summarizes the financial performance of a business during a specific period, reporting revenues, cost of goods sold, overheads, and the net profit attributable to shareholders. This income statement shows the revenues and expenses of a business. That's all the topics, and thank you for watching.